Chris and Dan show, what's up? So, we're in a recession, guys. Could be a depression coming up soon. Um, Shameless plug, if you want to be in a somewhat recession-proof industry, clinical research, the way to go, written by the two people you're seeing here on the screen.
Yep.
Comprehensive Guide to Clinical Research. Get it now.
Well, again's good.
Be recession-proof. All right.
Yeah. Plenty of job openings in this industry.
Take advantage of all the vaccine nonsense, guys. So, anyways, we've got. I was watching this yesterday. And I wanted to text it to Chris, and then for some reason I didn't. Probably because Ezekiel Elliott scored a touchdown when he was on my bench, and I was like, "Yeah, fuck this." But no, I think that's really what happened. So, basically, Chamath owns some specs. And he shut down a few, and he's in the biotech and in tech, regular tech and biotech. He's just going to share a little bit of why he's doing this and what he thinks about the economy. And it's something to like really consider here if you got money, what you're going to do with it. But we'll get into our opinions after. Let's just hear a little bit of it. It's definitely not an hour and a half. It's going to be minutes, and then we'll give our response and thoughts.
Everybody wants to know, Chamath, you've wound down 2 SPACs. Thank you for doing this for IPOF specifically, because people are replying to me every day asking, what are you going to SPAC? But IPO D and F, the money has been returned to investors.
No, it's going to be returned.
Going to be returned to investors, thank you. And Bill Ackman, of course, he wound down his SPAC, returning $4 billion. There's over 500 SPACs out there looking for deals. Tell us why this decision.
Look, I've raised 10 SPACs, six in technology and 4 in biotechnology. And I've done 6 deals, 2 in tech and 2 in biotech.
4 in tech.
Sorry, 4 in tech. 4 in tech, thank you. Biotech.
Yeah.
So a SPAC, refresh my memory. It's like a holding company.
Yeah.
It's a way to avoid IPO. It's kind of a way to avoid an IPO.
It's a way to make an IPO more efficient, but it doesn't work in a recession because basically you can raise the money privately, and then you take a small cap company that's already public, and you just take it over, right? So Lucid Motors was one. They got their SPAC was CCIV. So like Lucid wasn't public yet, but Lucid was a private company. And they wanted to go public. And then what they do is they partner with a SPAC that's also private or sometimes public. And they get a deal with them like, hey, we're going to privately sell you our shares to where you can legally make us go public through you, so that the CEO of Lucid doesn't have to deal with nonsense because they're not used to like do it. And they don't want to do the whole Wall Street tour. They're giving up a little more, but the convenience factor of it and the marketing from the SPAC. So this was like really popular during the bubble.
So a SPAC is a holding company
A SPAC is a holding company, yeah. So
it offers benefits to the company that's looking to go public.
That's right. So CCIV was one I invested. I actually made good money in that one, just off of the rumor that they're going to take Lucid public. So CCIV, you could buy shares in. It's a public SPAC. Like they exist to make deals like this. And so the rumor was CCIV, Churchill Capital the Fourth. They have like 8 of them at that time or something. The rumors were like they're going to get Lucid Motor, and if that deal falls through, they're going to get another one. And then basically that's a way for you to get in on Lucid early. It works in a bubble, doesn't work in a recession. Because it's way too speculative.
What about IPOs? Do those work well in a recession?
No, IPOs, it's very hard to get IPO during a recession. But in SPACs, SPACs are winding down. Right. So he's going to explain why. Hopefully I did a good enough job explaining what it is. But
no, I think from what I understand, I think that's correct.
That's the macro of like why they do it. Like Lucid didn't want to actually go public themselves.
Right.
They were looking for a SPAC to take them public. It was very popular in 2020, 2021.
I think there's other benefits, but I don't recall what they are.
Yeah, those are like the 2 main ones. But yeah there's others.
So the reason to shut it down is pretty straightforward. It's like, when we launched these things, the stock market was in a much different place than it is today. And so over the last 2 years at looking at deals, it's gotten harder and harder to find a good risk reward. Now, why is that? Well, the thing with the SPAC is you do a deal today, but it doesn't usually close for 6 or 7 months in the future. And so you have to do a deal where you have a really good sense that in 6 or 7 months, when the deal comes to close, that the price will be the same or even higher than what it is today. And if it isn't, all of the investors that you've brought along in the SPAC have a right to redeem, which is to say they file a notice that says, you can complete the deal, but I want my money back. And what they get back is the initial $10 that they used to buy the stock in the first place. Because when we started the SPAC, we sold stock at $10. And so from my perspective, I was looking at this and I'm like, this is a super volatile, ugly point in the market. This last year has been really problematic. I kind of said this last November, and Nick, we can play the clip after and we can come back to it. But basically my decision was that at this point to do a deal would probably, put a lot of capital at risk. And in all of these deals, I'm typically investing $100 million at least in each of them. And so I couldn't justify that. I couldn't see a good risk reward. And I thought the right thing to do, the responsible thing to do was just to wind these things down. I'll lose, I don't know, 10, 15, 20 million bucks for having set these things up. But we give everybody their money back, that $10. And I think that's actually better over the next 5 or 6 months than what it'll otherwise do if you're invested in the market. Now, that's a belief that I have. But hopefully when people get the $10 back in the next few weeks, if they want, they can go and put that money back in the market. And hopefully they'll do well. But, from my perspective, the risk reward was not good.
Is part of the issue the inventory that's available of great companies as well? That's one of the things I heard speculated on CNBC. It's hard to convince a private company to go public.
Here's my experience. When I was talking to all of these CEOs of these Silicon Valley companies, initially there was a lot of misunderstanding about what SPACs were. And I think we were able to dispel that because we had some really successful transactions. Then there was a lot of interest in being a part of it. In this phase, we were suffering from two very important things. One was that valuations were just completely up in the air. People had a huge question mark on late stage valuations because we would come in, we would do the work, and we would say the company is worth X. And that number typically was 50 or 60% lower than their last private valuation. And so when it came time for us to negotiate, doing the deal, even if the founder was roughly on board, the rest of the board was not, because a lot of them would have seen some pretty meaningful markdowns in their private assets. And when the company had enough money to kind of at least stay private for another year or so without having to raise money, on balance, those investors felt it was more prudent for them to not take the mark and to not take the deal at such a lower discount. So that was a big issue that we ran into, because every time we would price a deal, again, we're trying to create a margin of safety for us and our investors, again, because it's going to take 6 to 9 months to close a deal. And so ideally, you want this
a lot of valuation indigestion.
And then,
So basically, they go on for like an hour, but I always say in the research industry, it's important to look at the early stage biotechs, and in any industry really, and he's the one involved in the early stage before they go public, tech companies or biotech companies, and he's done with it now. So that's could be foreshadowing of worse to come. I know we're in a bad stock market already.
Well,
but it could be shadowing. It could be stopping future things from occurring and slow down in the economy from the early stage.
This is complete speculation on my part, but the way he presented the SPACs and then returning the monies invested by the initial investors, right? He said $10 a share. And then after that, he said something along the lines of, and hopefully, if they invest in the stock market, they do well. But his body language to me said he expects them not to do well by investing in the in the stock market.
Yeah,
right?
Yeah.
So, that's just one man's, interpretation of the current economic
a billionaire's
times.
interpretation,
Right, of current and future economic times. But I mean, I'm completely in agreement with him, and I think most people are at this point. But all of the big economists and those that have made fortunes predicting future outcomes. What's that dude's name? The Big Short. Can't think of his name, but you know what I'm talking about,
Yeah.
right?
Yeah.
Michael something, I think. But
Yeah.
anyhow, he's come out a number of times and said the entire system in the world's going to collapse pretty much, right? That it's all crashing down. He thinks it's going to be much worse than the Great Depression of the 30s for the United States. That's his prediction, right? So, I mean, and there's a lot of people saying this.
Yeah. Well, the whole purpose of the Fed, it's not to protect us, it's to protect the banks. That's why it got created in the first place. But the argument is the way they sold it to politicians is we can prevent that kind of volatility by having some control over
and they never
supply.
have.
Yeah, they never have, but they'll try.
Sure,
and rates are going up. So
and most people say post problematic era, the Fed actually made it worse. That's what most economists say when analyzing their maneuvers and the results.
But if you have to critique the Fed right now, I mean, they are doing what the textbooks say. You have to raise interest rates.
Right. Yep. You got to cool demand.
Yeah, and they should have done this a long time ago, but they are doing it.
Well,
it's probably unavoidable.
The biggest problem was when Biden got elected. And, politically, I kind of understand why he did this, although it was just completely asinine. But, he gave out $2.1 trillion to the people of the United States so that he could say, well, we did our part and helped the people as well by giving them money. Well, there was already an overheated system in terms of demand, right? So, and he just, pushed the gas a little harder by giving out that 2.1 trillion, I believe it was.
Well, Trump also gave out under his presidency.
Right. That's what I'm saying. He had to do the same thing to say, hey, just like Trump, we're doing our part and giving you money as well, which actually put us in the dire situation we're in now. I mean, we are already going to face problems with what Trump did. And what Biden did compounded the problem. And I would say not 2 times, but probably 4 or 5 times.
Yeah.
Right. In terms of overheating an already well-heated system, right? With all the demand that was happening.
Yeah. I remember we have it on video when we bought our Texas property. I don't know what our rate was. It was about this time last year.
Yeah. I think it was 3.75.
3.75. And at the time we were like, it's high because we're investors, but we'll do it. Now it's 7% for a primary, not for investor. For investors, probably 8%.
Is it that high? I haven't looked. It's 7%.
It's 7% if you have a 740 credit score right now.
Wow. Really?
Yeah.
I can remember my parents complaining. I was a really young child when we moved from Riverside to Yucaipa. I was like 6, but I remember them complaining about the rate. This was in like the 80s, late 70s.
In the early 90s, it was like 11, 12. I remember my dad telling me.
My mom and dad were complaining about paying 16% on a
16
home mortgage.
See, and I think we might be headed in that direction again.
Well, if things
we go from 3 to 7 in 1 year.
Yeah.
All right.
And that's not that's not the indicator. The indicator is it's doing nothing to slow down inflation.
Right.
That's the problem, because inflation is still just tracking it, just keeping its merry way.
I mean, home prices are not reflecting the drop that you would expect with such a huge rate increase, and that's honestly something I was going to talk to you and Joey about. Like, we may want to wait till those things go down.
Sure, it's primarily due to the inflation, is why, because inflation is going to keep prices high for items, right? Investment opportunities. And
they'll keep rents high still. So at that point, the ones who have cash are gonna win because prices eventually going to correct.
They're going to reflect the times.
And that's when the Fed can start stabilizing and then maybe cutting rates again.
Well, you're already seeing prices fall on houses, but not at the rate you would expect, at least in my opinion.
Yeah, not at the rate you would expect. No.
My house has fallen in price by somewhere between 5 and 10% over its high, right, of less than a year ago.
It's probably mine in Anaheim. The one in Yuma, less. There's been less supply here, though, or less demand. Less
Okay.
both supply and demand.
Yeah.
But yeah, it's for investors like you need cash, and just wait for the prices.
To fall. Yeah. There's another dude, I can't think of his name on YouTube that I kind of follow. Watch him. You do too. You've sent me a couple of his videos. I can't think of his name, but he used to live in California. He moved to Las Vegas. He's a real estate investor. He says he's not buying
Oh,
anything.
Graham Stevens?
Yeah.
Stephan? Yeah.
Yeah. He said he's not buying anything in terms of residential. He said the only thing he's considering buying is business properties. So
Wow, back to commercial bubble.
yeah, because he said they haven't risen as fast, and
Yeah.
he expects them to kind of maintain their value more so than residential. As a matter of fact, he's been selling all of his residential properties.
Wow.
So
Right.
he's predicting that the market's going to crash residential wise anyhow.
Yeah, I would
So.
expect so. But you know what? Thank God, man, I refied all my loans, like
Mhm.
the two here in Yuma. The one in Anaheim is my best, 2.875, which is now an investment property. I won't see that again in my life. So that, the supply and demand argument, anybody who has a rate like ours, right?
Mhm.
Why the hell would you sell right now? So I don't think it's going to do much to open up the supply. I don't see why would you sell your house at this point if it's an investment and you get such a low rate, or even if it's your primary and you can turn it into an investment. Like, why would you do it other than you need the cash? But
There's
why
one
would
other
you sell?
reason. There's one other reason that I can think of. So if you want to sit on a lot of cash, like right now, Warren Buffett's sitting on the most cash, to my understanding, that he's ever had, right? So you're considering what there will be available a year from now, right? So yeah, you're taking a hit on inflation because your dollars that you're holding are losing money every day. They're losing value every day. Excuse me. But if you expect, say, residential to fall by 50% a year from now, right? Which very well could happen. It happened in 2008 or 7. And that occurs, and you have enough cash on hand to buy 10 properties, opposed to if you didn't sell everything now, right? And you didn't have that cash, it actually makes more sense, right? If you're right that things will happen like that, right? Where you can say you sell your properties and you pocket 5 million, right? 5 million doesn't get you a lot right now. But if everything falls by 50% and you're not concerned with interest rates because you can pay cash,
Yeah.
it makes sense.
Yeah.
If you're right? You got to be right. That's the primary factor there.
I mean, to me, I never planned on selling anyways, unless I needed to, but especially so not now. Like, it pushes me even more in the position where I don't think I would sell unless I have to. Like, God forbid for some reason, but yeah, I just doesn't make sense to me. But you broke it down pretty good.
Yeah, I mean, and it doesn't have to be a year. I mean, you just have to do the math
Yeah.
on rates and what you expect prices to be when it does crash, if it does crash. I mean, you can do the math on how long of a time frame you have. Depending on those factors, you might have 10 years in which to be right. Just depends.
All right. Well, hopefully we didn't depress you guys enough, but it's okay. If we did.
Yeah. Well, here comes 20% mortgage rates.
Wow. You will own nothing and be happy.
Yeah, that's one way to get there.
What do you think that does to rents?
Well, if prices fall enough, right? Which that would certainly make prices fall, I would assume. I think rents have to correlate, don't they? Because you can't charge.
I was never sure how that actually works. I mean, I know raising
can't-
rates typically raises rents until the price starts going down, and then you get new buyers and stuff.
Well, they have to correlate with one another, right? If it's way cheaper to own a home, people will buy, right? Regardless. Even that may even take into consideration the mortgage rates. So if you're charging $5,000 a month on rent for a 3-bedroom, 2-bath house in LA, right?
Yeah.
And you can buy the exact same house and your mortgage and interest and all of that equates to $4,000, why are you not buying? Maybe your credit doesn't allow you.
But they will only buy when they can have that 20% down payment, right? I think that's
Sure, that's a big factor.
for that to bring on, and basically you're saying you want a new class of owners. And so for that to happen, for the masses to do that, prices have to drop.
Sure, and they do drop, right? We saw it, like I said, in 2008.
Yeah.
So, and you get a lot more people buying then, right? Because they have the cash. That 20% becomes a lot less money, usually 50% less.